Hello everyone, and welcome to this lecture video on Chapter 24, which is on capital budgeting and investment analysis. And as you can see from this slide, and hopefully you've read the chapter as well, so you know a little bit about what capital budgeting is, but what we're talking about is referring to decisions that managers make about what type of assets they're going to buy. So things like, do we need a new delivery truck? Do we need a new factory? Do we need to expand our factory? Those kinds of decisions. And it's not just necessarily long-term assets like a truck or a factory or a piece of equipment or machinery, although that's what we typically think of when we talk about capital budgeting. But it can even be something like acquiring a new company. So in recent news, this actually happened in March 2019, Disney purchased Fox. And that purchase of another business is actually part of capital budgeting. They're buying, in this case, many assets that make up the Fox, 20th Century Fox, and everything that goes along with that company. But that was part of their, they used capital budgeting decisions to make that decision to purchase Fox. So like I said, it can be anything from a long-term asset to a whole company that we're talking about here. So our course learning objective for this chapter is we're on number 12 in our syllabus. It says explain the nature of capital expenditure decisions and apply and evaluate various methods used in making these decisions. So there are 4 different methods that we're going to be talking about in this chapter: payback period, accounting rate of return, net present value, and internal rate of return. I am going to be covering numbers 1 and 2 in this video. Numbers 3 and 4, because they are much more complex, I'm going to be discussing in class. But I think 1 and 2 are simple enough that you guys, with the book and with this video, should be able to figure them out on your own. So I'm not really going to spend much class time at all working on those. Like I said, capital budgeting is the process of analyzing alternative long-term investments and deciding which assets to acquire or sell. Like I said, here we've got this manager and he's deciding, well, do I buy a new delivery truck or do I buy a new factory? What assets do I want to acquire, or sometimes we need to make the decision to sell off old assets. But the point is, all of this is long term, something that we're going to have for a long period of time. It's not a short term decision like I'm just going to buy some inventory that I'm going to sell off in a month. This is something that we're going to be with for a long period of time. Now, the issue with capital budgeting is that we have a limited amount of funds to invest. We can't buy everything that we want. We can't buy a new truck and a new factory and a new piece of machinery and all this stuff. We have to decide what we're going to do with that limited amount of funding that we have. So how do we make this decision? Well, managers say, I will choose the project with the most return on investment. So let's talk about what that means when we say return on investment. Okay, let's break it down, those 2 words, return and investment. So return, kind of like, when you is the amount what you get back. Okay, so you think about like a return at a store, right? You're returning it, you're giving it back to them. So the store is getting that return back to them. So a return is what you get back. Investment, notice I've underlined the word in, right, is what you put in, okay? So we want the most back from what we put in. That's what I mean by most return on investment. We want to get back the most back out of what we put in. So we need to analyze, well, is the truck going to give us the most return on our investment, or is the factory going to give us the most return on investment? Or maybe we're deciding between 2 different types of trucks, or maybe we're deciding between 2 different types of factories. But these are the decisions that we have to make. Now, capital budgeting is extremely difficult. And the reason why is because it requires predicting what will happen in the future. Now, unfortunately, none of us have a crystal ball to be able to say for sure what's going to happen in the future. We're just predicting. And it's very difficult to predict what's going to happen in the future. On top of that, capital budgeting is risky. Okay, and it's risky for 4 reasons. First of all, because it's all based on estimates, the outcome is uncertain. We don't know if what we estimated was going to happen is actually going to happen. Again, we don't have that crystal ball. So it's very risky. We don't know what's going to happen, okay? It's also risky because large amounts of money are usually involved, right? We're not talking about buying supplies like pencils and paper. We're talking about a big piece of machinery, a vehicle, a factory, a building, and even, like I said, another very large business. Okay, so large amounts of money are involved, and that means it's risky. In addition, as we mentioned, these investments involve a long-term commitment. This isn't like a pencil or a piece of paper that we're going to use, for a few days and then it's going to be gone. No, these are things that we're going to be with for a long time. When we buy a vehicle, we think we're going to use it for 5 to 10 years. When we buy a building, we think we're going to use it for 20 to 30 years. So this is a long time commitment. And it's also risky because the decision may be difficult or even impossible to reverse. Okay, think about it. When you start construction on a new building and it's built, you're kind of stuck with it. It's not like, again, you can't like take it to the store to return it like you would with if you bought too many supplies at Office Depot, you just take, some of it back. No, we're talking about a building. You can't just take a building back to a store to return it. So whatever you're doing, you're kind of stuck with. It's very difficult to undo some of these capital budgeting decisions. So an important aspect of capital budgeting decisions is considering cash inflows and outflows. And there are different inflows and outflows at various stages in the life cycle of these long-term assets, right? So these are long-term assets. We use them for a long period of time. So there's 3 distinct phases. There's the acquisition phase when you first acquire the investment. There's the use phase when you're actually using the equipment. And then at the end of the useful life, there's the disposal where you actually get rid of it. Okay, so in the acquisition phase, that's a cash outflow. So you see this negative here, that means it's an outflow. You have to pay cash for your new machine, or in this case, it looks like a printer. I don't know, these look like machines to me, but you have to pay cash for them. So that's an outflow of cash. Then when you use the equipment, there's inflows and outflows. So the inflows are the additional revenue that's going to be generated from these additional machinery. Like we're going to use this machinery to make product, like maybe a new product line or something like that. And we're going to sell that product. Well, that's going to be our revenue. But of course, there's the cost of those items, of using this machinery. You're going to have the electricity and the labor costs of the people operating the machine and also repairs and maintenance and things like that. So you have the inflows from the revenues and also the outflows from the operating costs just to run the machines, as well as the repairs and maintenance on the machines. Then at the end of the useful life of the asset, you get rid of it. And hopefully, if there's any value still there, you can actually sell it. And when you sell it, you're getting cash back. So you see a plus sign here, that's a positive cash inflow from the proceeds. And another word for that is salvage value. You probably learned that back in Chapter 8 in Accounting 1A. I know it was a long time ago, but salvage value is the estimated value you think your asset's going to have at the end of the useful life. So hopefully when you sell it, you can recover that value back. So now that we know the basics of capital budgeting, let's talk about briefly the 4 methods of investment analysis. Okay, there's payback period, accounting rate of return or ARR, net present value or NPV, and internal rate of return IRR. Now I broke these up into 2 categories. The first 2 items, you see a clock with an X through it. That means they do not consider the time value of money in these methods. And then these bottom two methods, you see a clock, and that means they do consider the time value of money. Now we're going to talk about time value of money at the very end of this lecture video, but just keep in mind that payback period and accounting rate of return are the ones we're going to talk about in this video, and they do not consider the time value of money. So first, let's talk about payback period. Okay, now I have this example problem here. It says Star Stadium is considering purchasing vending machines with a 5-year life and a $5,000 salvage value. So this stadium, we don't know, they play baseball or soccer or whatever they play there, but they want to make a little bit extra money by having vending machines because the people, at these stadiums might want to buy some snacks, and that may be a good revenue source for us. So the cost of these vending machines is $75,000. And then we break down the additional revenues and expenses that these vending machines are going to provide. So we think we'll be able to sell $84,375 of product out of these vending machines. And then our costs are the cost of the goods that we're selling, so the actual snacks inside. But then we also have operating costs. So maybe that's the cost of the electricity for these vending machines. And maybe that would include the cost of the vending machine operator who has to, restock the vending machines. And it would also include things like the repairs and maintenance on the vending machines. Then there's also depreciation expense, which hopefully you remember that term from 1A, what depreciation is. That's really the cost of using your asset. And that gives us our pre-tax income. Then from there, we subtract out our income tax, and that gets us our after-tax income. Now, I want to talk a little bit more about depreciation and how we came up with this $14,000. Well, as you hopefully can recall from Accounting 1A, depreciation, like I said, is the cost of using your asset. It's basically taking this $75,000 and spreading it out over the 5-year life of the asset, okay? Because we're going to use it over 5 years. So the formula for depreciation, using the straight line method, which, by the way, is the only method I'm going to have you responsible for knowing in this chapter, is cost minus salvage value, which, as you recall, is the value at the end of the life of the asset, divided by the useful life. So the cost was $75,000, which you get right here. But we think at the end of the useful life of this asset, it's going to be worth $5,000 for these vending machines. So we subtract out the salvage value, because that means we're not going to be using this $5,000. We're only using $70,000 of the asset, because then at the end, we're going to sell that last $5,000. And then we divide that by the useful life of 5 years, and that's how we get this $14,000. This is our annual depreciation. So this, by the way, is an annual projected income statement. We don't know for sure how much money these vending machines are going to make. Again, all of this is an estimate of what's going to happen in the future. So let's talk about analyzing this investment from the perspective of payback period. So payback period is the time we expect it to take to recover the initial investment amount, or how much we put in. And the formula for payback period is the cost of the investment divided by the estimated annual net cash flow. So cost of the investment is how much you put in, and the estimated annual net cash flow means how much we expect to get out, okay? And payback period is expressed in years. So it kind of tells us how, when it says this is the time we expect to recover, how many years will it take us to get our initial investment back? So we'll walk through this problem using the payback period method in part 2 of this video.